So throughout the slides that David was going over, he mentioned a couple times that we had to be federally compliant. And what that means is if you charge any sponsored grant, if you charge any money that comes from the research foundation or from the Office of Sponsored Projects, you have to follow the rules that we're getting ready to go over. And that's because the government wants to see that the money that they're giving to these sponsored projects are being used correctly and being charged correctly. So the first couple slides we're going to go through are actually going to be rules for federal grants in general and things that you can budget into them and things that you can charge against them. And then we're going to go through one of the handouts that David just passed out, which is the FAQs for 821. We're going to go through those because those have rules, and an organization that I'm a part of, the ABRF, worked with NIH to get those rules outlined and to have what are the most frequently asked questions, because the language that used to be in the 821 guidelines was so vague, and it was really hard to decipher what the rules actually were. So an outside organization worked with NIH to get those FAQs created to kind of clear up some of these issues. So we'll go through the slides, and then we'll go through the handout that doesn't have the blue underlining. So we'll go through the other one. The other handout that you're given is actually I'll explain why. It's a great handout to read through. About 2 years ago, we rolled 8 different circulars. So I'm talking about Circular 821, which is specific to core facilities. But 8 different circulars from the government were all rolled into one, and it's now called the Uniform Guidance. And the other handout that was given was just some of the FAQs regarding that change and some of the language that might have changed during that roll-up. All right. So the Federal Office of Management and Budget issued circulars to define principles and standards for projects, basically what I just said. In December 13, they rolled 8 different circulars into one, which is now called the Uniform Guidance. The Uniform Guidance establishes principles for determining costs applicable to grants, contracts, and other agreements with educational institutions. I kind of already covered a lot of these. So the Uniform Guidance deals with what is allowable and not allowable to be charged to grants, what are the indirect F&A costs, how do you do time and reporting, and what are the cost accounting standards. We're not going to cover all of these today because not all of them are pertinent to core facilities. Time and effort reporting, that's something that the Uniform Guidance covers, but it's not something that's really pertinent to core facilities. We will talk about, I know this is one of your questions, we will talk about how effort goes into building fees and how effort can be applied to core facilities. But effort reporting, that's not really that pertinent to actual core facilities. That's pertinent to how does the PI track its time on a grant and what are the rules with that. So Uniform Guidance says what is allowable, allocable, reasonable, and consistent. So allocable must be a assigned portion that is based on cost that can be charged to the grant. So time and effort can be a part of those expenses. So anything that's allocable, what are specific reagents, supplies, personnel that goes into providing a core service. So is it allowable? There are certain things that can. Equipment is one of those things that cannot be. So equipment would want to be things that are unallowable. So federal guidelines we'll go through in the 821s and institutional rules. That'll be part of the earnings guidelines. The university follows a lot of these things with the federal guidelines. So the things that are allowable are personnel time, supplies and reagents, depreciation on equipment, and depreciation is set by the university, or it's going to be set by Nationwide Children's. If you buy $1 million piece of equipment, they will tell you how much has depreciated each year, and that's how much you can roll into your fees. Examples, so I said salaries, lab supplies, participant payments, services from a core. So things that are unallowable. Alcohol, we cannot take people to lunch and buy them alcohol or take them to dinner and then roll those things into our fees to then charge other people. That's unallowable. This is also particular to specific grants, you're not allowed to charge alcohol to grants. We can overhead items and services and personal use goods and services. If you go out and buy things from the Buckeye Corner, you cannot then say, oh, I bought this from the Buckeye Corner, I'm just going to charge it to my grant. And then as it relates to Coors, because I bought this from the Buckeye Corner, I can't roll it into my fees. So buying new hoodies for everyone in your core from the Buckeye Corner, that's not going to be a good use of core money, and that won't be able to be built into your fees. So reasonable. Will it pass the prudent test if we printed an article in the Columbus Dispatch and the federal government saw it, or just Joe Bob on the street saw it? Would he be okay with the things that how we're spending our money? Would be okay to show that Dr. Caligiuri took 15 people to dinner and spent $2,000 on alcohol? Would that be all right? Probably not. So we just also want to be consistent. When we talk about consistency, we need documented ways that you're being consistent. So how are you estimating your cost? If you estimate your cost one way this year, you want to say it in a very consistent and similar way the next year. So we have, when we're doing our fee calculations, which we will get into in the next session, the university requires that we keep track of how we created our fees. They don't want to see that change drastically over the course of a couple years. If you figure them out one way one year, you want to do it a very similar way the next year. Obviously, things change, and there are reasons why we do things different from year to year, but we want to show why. Why did we decide to go from calculating fees on an hourly basis to calculating fees on a sample basis? So we have internal controls, and that is the office of the controller's office that Dave had mentioned, and they do require backup documentation. The CCC has been audited on their core processes the last 2 years, on our surpluses in certain cores, how we created fees in certain cores, and then they've asked for backup data for the last couple years. They wanted to see, how did our genomics core come up with its data for the last 3 years? How did we determine those fees? So we always want to document what we're doing and make sure we're following the rules that are set forth by the university and the government. So, like I said, we have been internally audited. There are audits that are done by the national government on recharge centers. And the government calls them, if you're NIH subsidized, they call them specialized service facilities. You can call them a shared resource, you can call them a core, you can call them a recharge center. They're all basically the same thing. And if the government comes in and asks you and audits you because they know you've charged their sponsored grants, they're going to want to see the information we just covered. Here are a list of some universities who have been audited by the national government. We need to update this because I'm sure there have been more since 2006. But here are some of the audit findings. So I made some in bigger that really pertain to core facilities. They had unallowable costs. They had a lack of documentation. They had no account monitoring or indirect cost monitoring, which are very inappropriate cost transfers. So Dave had mentioned in one of his last slides that we can't transfer surplus to another area, and that's what that means. They had inappropriate cost transfers out of one core to support other facilities. This also means that when they were audited, they could have also found inappropriate cost transfers between projects or between university funds and projects or another funding source and projects. Here are some of the consequences for NIH audit findings. If you can tell, this is you'll see the slide in person later when we send them to you, but I think the lowest amount is $1 million. The lowest amount is $887,000. That's a lot of money. That's a lot of money for the university to pay if they were to be audited and find that we're not being compliant with their rules. So, when you have a specialized facility within the university, you're going to provide services or products which means access to equipment, either manual personnel time or expert consultation, to other researchers. The users are going to be primarily within the university. The university is going to have different rules if your primary customer is outside the university. So for most of our core facilities, 90% of our customers come from inside. The university is going to have other taxing requirements if most of your customers come from outside the university. And you cover all your costs through your user fees. So the first thing you need to do is determine who's going to purchase your service or product. Dave went through a list of your potential customers that the university asked you to report. You're going to develop a budget, which Dave walked through. When you're creating your earnings fund, that's going to be one of the required fields that you have to think about. So then to create your fees, you need to allocate your costs to your service. And then you can only recover what is allowable, allocable, and reasonable for your direct costs. And charges must be applied consistently. And what that means is if Joey's a PI and Gayla's a PI, I can't adhere at the university. I can't charge Joey more just because he works in the cancer center and charge Gayla less because I like her. So everything has to be charged consistently, and that's actually not only a federal guideline, but a university guideline. All PIs at OSU have to be charged the same rate. They cannot receive a discount. And we can talk about ways you can give them a discount and how you can work around that, but it's not really a discount. Somebody is always going to pay for the difference. So we have an example in one of our cores that use our online management system that because they are a PI of a specific department, they get a percentage off their services. The PI pays for their piece of it, but the department physically has to pay for the difference. They have to pay the discount because you cannot show that one PI pays more than another if they're both OSU PIs. You can charge external PIs a different rate. But if you're charging an external PI and they're federally funded, you want to also give them some sort of discount. So what you want to take out of those fees are going to be and we'll cover this in the next session, but I just want to kind of give you a preview of how to think about fees. If I'm federally funded and I work for the University of Michigan, I would extend from OSU a discount to them because my core is federally funded and I follow the federally funded guidelines. So I'm going to give them a little bit of a discount, but I'm going to take out all of my internal subsidies. So if OSU covers half of my salaries, because just out of university funds, out of like institutional support, I don't have to give that discount to any other federal fund. But if I get federal money, and I'll explain what I mean by that in just a second. If I get federal money from the government to support my operations of my core, then I'd have to give that discount to other people. And sorry, I just realized I got a little bit ahead of myself. Some cores are not only charge federal grants, they actually get federal grants to help support their operations. So some of our CCC cores, not all of them, get money from the government to support their operations, like $50,000 a year. And if that $50,000 a year goes to support the core operations, I have to give whatever that discount that $50,000 gives me, I have to give that to all federally funded. And that's another rule to stay consistent. Make sure we're giving everybody at OSU the same rate. Make sure we're giving all federally funded PIs the same rate. Questions on that? That gets a little tricky, and we will cover that more when we go over fees and how to calculate those. All right. So your schedule of rates should be established using a documented method. We've talked about that. Can't discriminate against federally supported activities, and rates must be designed to cover only the aggregate cost of the services. So we can't inflate our rates because we don't want to run a surplus. So the billing cycles are usually established by the institution. OSU would really like to see us bill monthly, but the federal guidelines state they want us to bill on a regular cycle and establish that in the shortest increments we possibly can. And all billing and cost recovery has to happen after the services are provided. We cannot pre-charge people for our services. You cannot charge a grant for services you have not yet provided. This goes into a long way because a lot of times, if any of you work with people who have grants, they're saying, my grant's ending on Friday. I need you to bill it. That is not allowable. We kind of have a couple gray areas in the Cancer Center. I'm going to put this on record, I guess, now since we're recording these things. If we have the samples in hand in the shared resource and we're physically working on them, we start the process of billing. But if we're not going to get the samples for 6 months, we haven't even started, they just want us to use the money and put it aside for something else because they're going to want to use the money, but they're not quite sure what, but they don't want to lose their money, that is absolutely unallowable and we will not do it. Not only because it puts our shared resource at risk for audits, but before we started making sure we followed all these guidelines appropriately, that came back to bite us big time. An example that happened about 6 years ago, before Veronica and I were on board, someone billed $60,000 to a grant that they were going to lose if they didn't use it. Well, almost 4 or 5 years went by. People who had said that that was okay and who had done that didn't remember it, but that PI remembered it and came back, and Veronica and I had to track down and find where that money went, and we still had to honor. We had charged that grant, and we still had to honor those services. Well, now that grant, that shared resource was already in a deficit. We now had to provide essentially free services that we had charged 4 or 5 years in the past, which just comes back to bite you because that money just gets lost when you change fiscal people, when you change core directors or core leadership or core staff. So in an actual example of it happening, it's not a great thing to do. It comes back to hurt you. But it also is not allowable, that you cannot pre-charge for services that you have not done. Yeah. So then rates were going to be reviewed, and for government it says every other year, but for OSU's requirements they say every year. You have to report on your rates every single year. Okay, carry forward and surpluses. David kind of touched on this a little bit towards the end. If you have a carry forward, a surplus, or a deficit, you have to use those to recalculate your rates. You're going to adjust up or down. We'll talk about how to roll surpluses or deficits in when we talk about our fees. So subsidies. I'd mentioned, as I said, I got a little bit ahead of myself. Subsidies come from either the government or the institution. So OSU, there are certain cores on campus where OSU pays all salaries. And the only thing the customer has to pay for are the services or the supplies and service contracts and those types of things. That is a huge university subsidy. So the dollar amount of all of those salaries is what your core is being subsidized by. Or you can have, in the case of the CCC or the CCTS, where we subsidize cores with federal money. Were you here for the core management training? I'll come on in. So like I was saying, there's institutional subsidies, and then, yes, question?
So are you regulated differently then? If you're getting subsidies from the institution as opposed to grants?
The question was, are you regulated differently if you're getting subsidies from the institution versus subsidies from grants? The answer is you're not regulated differently. It's going to be how do you create your fees. And the thing to remember with all of these regulations that I've kind of just gone over, these come into play if you charge any federally funded grant. You're subject to these rules. If you don't charge, you're never going to charge university or federally funded grants, and you're only going to deal with university money, you're only then subject to the earnings guidelines. But as soon as you charge a federally funded grant, you're subject to all of these rules. But as far as subsidies go, if you're subsidized by the university or the government or both, that determines how you charge. your fees and what dollar amount you're going to put towards a service cost. Does that make sense, the difference? Okay, so in the CCC, like I said, under our core grant, we get a lot of subsidy from NCI for for some of our shared resources. And we write those up in our core grant every 5 years, and they get a certain dollar amount. And we put that money towards supporting the operations. So not only because we charge federally funded grants, but now we get subsidies, we are now subject to all of these rules. Questions on subsidies or where they could come from? Okay. So your income. Excess of full cost may need to be treated as program income. And I copied directly from the Uniform Guidance what program income is. And it's any income that's earned that was directly generated by the grant-supported activity or earned as a result of the award. So there, and I don't think she showed up today, but there was a unit that was supposed to come today that they actually run their earnings through a grant that they received. And I wanted to actually work with that person because that would fall under program income. They received a grant to create a specific software. That software is now being sold to other places on campus. That would be program income. So does that make sense what the difference is? So you got federal money to do something, to provide a service. Now the money you're getting back from that, anything above cost recovery, is considered program income. And program income has to be reported differently to the government.
Can you use program income to build that up?
No. You're not going to want to you have to report it, and then they can tell you how you can use it. The government can. So, does that make sense? So you have to report it. You can't just build it up and say, we're going to use all these, we're going to do it to this, this, and this with it. You have to report the program income to the government, and then they're going to say, with that income, you can do X, Y, and Z.
You only have program income from a government, or can you do program income without the government being involved?
No, the program income's a definition straight from the government. Program income, if you just have a service here on campus, that's not going to be program income. Program income's going to come if you earned that income because of a grant that was provided. Did you have a question?
You may not know the answer to this, but is there a patent licensing issue with that? Who would own the patent?
Who would own the patent? That's a good question. The question is, who would own the patent for anything that comes out of a program income situation? I'm not sure, but I'm going to write that down so I can find out for you. Okay. Oh, and the last thing on the slide was you may need to collect sales tax. So earlier I mentioned that if you have a certain amount of external customers, that will indicate whether or not the university will make you collect sales tax. I think right now the CCC is running under, we have less than 10% of our customers are from external, so we're not subject to collect sales tax. But that if there will be a contact on one of the slides, if you're concerned that you should be collecting sales tax because you have a lot of external customers, you should contact, his name is Scott, and he'll be able to tell you if you should or should not be and how to do that.
So what is the first, you said you're at 10%, so you're not subject. What is there a cutoff?
We haven't been given a specific cutoff. We just provide those numbers, we calculate them, and then they tell us that it's that it's okay. So Veronica would know best, and I'll actually put taxes under my questions for Veronica on when you at Nationwide Children's would owe tax.
And remember that some of your outside users are going to be tax-exempt institutions anyway, so that wouldn't count as somebody that should pay tax anyway. Companies would probably have to pay taxes.
Yep. All right, so we're going to go through the circular A21 or uniform guidance. The handout, Dave passed out the handout. We're going to go through the one that has the yellow highlighting throughout it. But it's about 5 to 10. Dave, would you be okay with taking a 10-minute break right now? Sure. Awesome. So go ahead and we'll get the slide switched over to the PowerPoint and figure out, or the Word document switched over to there to figure out what's the best way we're going to do that. and then we'll come back. So let's say 5 after 10. Thanks. For those of you who came in late, we have bagels and coffee out this door right here around the corner to the left.
Lots left.
Oh, though those are the ones that have the crunchy cinnamon stuff on top. Yeah. Oh, they are good. I think I've had it. Oh. I might have to steal a blue one, or a blueberry one. Those are my favorite.
Yeah, they're blueberries. Yes, please take some back. There's a lot of them.
So I guess I got to give you a ride back. We'll go get some, yeah. I will give you a ride. I'm going back there. I know. It's your punishment for being late. All right, since everyone is back, and I don't know if anyone actually took a break, but we'll go ahead and get started. Maybe we finish a few minutes early. We're going to go through the A21s. Does anyone have a problem if I sit here while we're going through the Word document? Awesome. So you'll notice throughout that there are some highlighted sections, and those are from previous core management trainings that we've actually highlighted. I think that these are the most important things. But we'll actually take a look at all of the questions and kind of just look through the answers. And the yellow highlighted things are the ones that kind of spur more discussion, and usually people have a lot of questions about what does that mean, and what just more in depth. So feel free to ask any questions that you have. So we'll go ahead. The beginning is just an introduction to what these are. So like I said before, NIH worked with a third-party group to kind of come up with questions that everyone was having for A21, which was the old circular, and how they pertain to core facilities. Sorry, you weren't able to introduce yourself earlier. Can you just tell us your name and what area you're from, just so that we know?
So I'm actually Misha. I'm faculty at BCC.
Okay.
And I deal with core facilities a lot of time. Sometimes, I'm off of procedures and I don't know anything about it. So I thought, why not?
Okay. Sure. We just want to make sure we're answering all questions and covering all bases with things that we talk about. So just feel free to ask any questions that you might have. So the first question is, what is a core facility? We've kind of covered that today. They provide services, instruments, technology, and services, and expert consultation to scientific and clinical investigators. So we've kind of beaten that one like a dead horse. So we'll move on. And core facilities they're fiscally supported by institutional funds, federal funds, or external revenue, or other funding, and any combination of these. No matter what the source of the funding for a core facility may be, the cost issues discussed should be observed if NIH grants are charged for the use of a core facility, or if an NIH grant provides general support to establish or operate a core facility. So that goes into the things we just covered. If you're charging a grant, you're going to be subject to these rules. If you're given money to provide a service by a grant, you're going to be subject to these rules. So, how are NIH funds used to support core research facilities? They can take form by a subsidy. So there's an example below of how you can put that subsidy towards your fees. So your total allowable cost is $110,000. The support is $60,000. So your net direct cost is $50,000. $50,000 is your all of your operating expenses once you take out the institution or the federal subsidy. So then to figure out your fees, you take what is your anticipated usage and divide your operating costs by your anticipated usage, and that gives you your unit. So that is the most basic way to figure out your fees. If you're only going to have one fee, you take all of your operating costs, divide it by your anticipated usage, and that gives you your fee for your service. I know a lot of you work in labs or work with labs. You have 50 different fees. They're very complicated to come up with because you can't just charge the same rate for everything. One thing takes you 2 minutes, so you only want to charge $5. The another thing takes you 5 hours, so that one should be $500. So you can't just come up with one basic fee. So when we come back next time, there is a cost calculation spreadsheet that we'll go through that'll help break out those fees and kind of give you a general idea of how how you can apply different costs to different fees. But just for the NIH guidelines, that is how you apply a subsidy. You put your subsidy, you take it off of your total operating cost, and you then use that bottom number to determine what your fee is. Any question on that? You would do the same thing for institutional subsidy. So if we're using the same example, we have 110 as what our operating costs are, $60,000 is how much we get from the government, and say $10,000 is what we get from institutional subsidy. The amount we charge back to our customers is $40,000. And $40,000 divided by your anticipated usage. That would be your cost for your per fee. Any questions on that? Okay. There are a couple in-depth examples here. Feel free to read through them. All of this materials is yours to keep. So part C is, are cores limited to the types of costs they may recover on an NIH grant? And the answer is yes. You can only recover things that are allocable, allowable, and reasonable. So we went through those in our previous slide. In our previous slides. So how should a specialized service facilities be considered in the context of these FAQs? So they are going to be anyone who provides services to another PI and are subsidized by the government. We've kind of covered the parts that aren't highlighted are kind of been drawn out in this slide, so I'm just kind of going through those quickly, but please stop me if you have any questions. So, how should costs be allocated when a core facility offers multiple services? So I'll read the highlighted portions. It's possible for an institution to group multiple types of instruments and services under a centralized core infrastructure. Such an organizational structure may spread costs among subcomponents of the central core. And then one service in a core can support the services of another. So what that means, earlier I said, we could not take money that we earn in our core and support operations in another core, other areas in the organization. But I also said that it's not feasible to charge $50 for something that takes 2 minutes and $50 is something that takes 3 hours. So what you can do, but let's say that thing that takes 2 minutes to do and nobody's going to pay more than $5 to do actually costs us $1,000 to actually provide that service. Once you add the personnel it goes into, once you add the service contracts for the equipment that it takes to do, the cost is astronomical, and it costs $1,000 to run that one service. But nobody's going to pay $1,000 because they know it takes 2 minutes and it's not very expensive to do. And to them, in their PI's mind, so they only want to charge $5. But let's say this other thing that takes 5 hours to do really doesn't take that much of our resources, and it's really cheap, and it only costs us $50. We can switch the way we charge things. We can charge more for something that costs less and charge less for something that costs more. And I can give a demonstration I can write on the board and draw out an example. But the reason being is we can use one service to subsidize another service. And that's what this is saying. If something costs $1,000, but we can't charge $1,000 because nobody's going to pay $1,000, we can decrease the rate on that. But then for something that costs $50, we can increase that to, let's say, $200, because that's a reasonable cost. That is similar to what is being charged at market rate. When you look around at other universities, other companies, that's about what they charge. So we can increase the rate on that so that they balance each other out. Questions? Angie, you have a...
You got me curious as to whether or not those are published rates. You can see what other places are charging.
So yes, so we don't publish how we calculate our rates. But you do publish your rates, and other universities do publish your rates. So if I'm looking for what other universities charge for our genomic shared resource, how much does it cost for next-gen sequencing on a HiSeq 2000? If another university has a HiSeq 2000 and they have a core facility, they're going to have a website with their fees on them. So we can see. We actually do a market comparison for all of our grant submissions. So those are out there. One of the things, and we'll get to later, is we just can't charge above we can't market gouge. We can't then charge above what the market rate would be because we're the only people who can provide that service. Does that make sense? Okay.
Not a violation of like antitrust laws to charge what somebody else is charging just because somebody within another organization about not discussing your fees with other people who do the same thing because it could be a violation of antitrust law.
So I can see that if you're in if you're not subsidized by the government or you're not doing any work with federal money, that maybe that's something you would consider. Unfortunately, if you're dealing with core facilities, a lot of them are either charging for sponsored grants or they're being subsidized by a sponsored grant. So in that case, there would be you would want to discuss what your fees are because the government wants, and that's part of the reason they have these rules, is that even if you're at a university in California and I'm here at Ohio State, they want to make sure that all of their investigators that they give money to across the country are getting the best rates possible because they're providing that money as the government to either provide the service or to pay for the service. So when it comes to core facilities, that wouldn't be such an issue, but I can see that for non-core facilities. Or David, do you have an opinion on this? For things that if you don't want to let anyone know, well, I'm doing this for $100, I don't want them to start doing it for $100 because then they're going to take all my business. That comes into play. So we have a competitor. We have in our genomic shared resource, we do Sanger sequencing. And we were charging, I think, let's say $4.50 a sample. It was in the $4 range. So we were charging $4.50 a sample, but then because we were charging $4.50 a sample, which was actually to cover our fees, we couldn't charge any less than that. A third-party company came in and put up boxes all around the campus saying, well, they charge $4.50, we're going to charge $2.75. Or we're going to charge, I think they charged, it wasn't $2.75, it was, they charged like $3.50. So then that undercut our core just because they could. They were a third party. They get thousands and hundreds of thousands of samples a day from all across the country, and they could do that. So we had to then decide, is this a core service we're going to continue? We kind of put some feelers out there and found that this was something that a lot of our researchers relied on, and they liked having the expertise here on campus. We were able to reevaluate our fees, and when I talked about you can subsidize within your core with other services, we ended up doing that. We pushed more of our subsidies onto that service so we could decrease, and we decreased our fees to $2.75. We didn't push, and that was because we did it cost-based, and because that's all we can do is be cost-based. And so ended up bringing in a lot more customers. They're more happy with our service because we're here on campus. They can come to us and ask us questions, and we've been doing it for such a long time, and we have the expertise. And those are the kinds of things you also need to push, is to say, we have the expertise, and we're willing to work with you on anything that goes wrong. Whereas if you're just putting your samples in a drop box and they pick it up, and then just because they can have your data back doesn't mean they're going to be the best person to run your samples. So,
and the converse of that is, especially if you're selling to the public, you don't want to undercut the public's fees. So if a widget costs $500 out in the real world, we can't market out there for $200.
Yeah.
Because we're not supposed to undercut the general market.
Yeah, we don't want to do that just because we can't. Everything should be cost-based. If our cost and our fees is really $200 to do that, then we can say that, but we have to be able to then prove that we're not undercutting them on purpose. This is our fees. This is what it truly is to calculate it. And what's going to end up happening is if they're gouging their prices that much, they'll probably end up dropping theirs if they're overpricing things. But you can't intentionally charge what's over market if it's not based on your fees, but not based on cost. Okay, questions on how to subsidize within your core with other services, but you can't share money outside of your core. Okay. Can one support card another? That's the next question, and the answer to that is generally no. So it says if the core benefits or utilizes the services of another core, then appropriately determined and documented charges can incorporate in the charges of the core utilizing the services. The rates for service should include only the cost of that service, and investigators should be charged only the cost of the service that they are using. So I think Mindy and Amy, you guys had talked about when I met with you, possibly you need the money to go to different places because it's different people. That's what this is kind of saying, is that money, your one charge, is getting split into three pools, 3 different units. And that's kind of what that's talking about, is that so the money is not really going to support another service. It's actually supporting the service that is there. So for everyone else, I won't give you your specific example, but say you have a service that touches, another service that came up is going to touch our microscopy, our proteomics, and our genomics core. But it's going to be one project and one service. But all 3 of those shared resources need to touch the process. When we charge, we're going to charge one fee, but that money is going to be broken up into the 3 areas. And that's what this means by, if the service is being provided by another area, you can charge it within one and then share it with the other because the service is actually being provided elsewhere.
We had a circumstance where we needed, let's say, sequencing done on a plasmid. They wouldn't let us do it in our own sequencing facility because of cost problems. So why couldn't one core ask another core to do a service for that core?
No, that's not anything. We have our cores. We actually ask them. We support them in doing things together, so that one core isn't sending things to another university or another institute to do. So that seems odd.
Okay, we thought that too, but okay.
Yeah, that seems odd. We do.
About shared, that's why I was wondering if there was a rule about that.
Yeah, so for that example that I gave for our genomics core, they could use any theoretically, if they need to use a mass spec piece of equipment, they don't have to go to our mass spec and our proteomics, but we encourage that, and we'd say, we want you to use our core. One, they're right here on campus. We're going to get the best rate we possibly can, and then that's just going to look better for us that we have cross-core collaboration. Now, the only thing I can think of is we also have a core who has next-gen sequencing done. For certain projects, it's actually cheaper to send it to Nationwide Children's than it is to send it to our core, our genomics core. So in that case, when there are cost issues, when it's actually cheaper to send it somewhere else, we say, yeah, go ahead, because we want the customer to get the lowest rate possible. But as far as we usually try to push people to use our cores within our cores. If our core's working on something, use one of our other cores if you need it and not send it to another institution's cores. So I would follow up on that with, I don't know when this happened, but I would follow up with Veronica on that one if, yeah. Because I would think they would want you to utilize your core. So how should institutional fiscal contributions to the operation of the core be managed and described in an application to NIH? So the cost circulars do not require that the core as a whole break even. So basically, they want everything to be managed centrally, and to only charge for actual costs and the bill on a set basis. And they also want, I'll just read the yellow parts that'll help clarify this. The cost circulars do not require that the core as a whole break even, only that the cost allocations are consistent with federal cost principles, and the charges for services are reviewed and adjusted as needed to assure that there is no recovery or overcharge to federal projects. Institutions may decide to utilize institutional funds to support the operation of the core facility. So I should have also mentioned that we've gone through anything that's in the red writing are notes that we've kind of added for you. So that is, so takeaways, just if we felt there was like other clarification that's needed, we've added that in the red writing, just so you know, that's not actual language from NIH. And these, so institutions could support the core services, and these need to be added back into rates to external customers. So I mentioned that with the last slide deck, that if we're charging an external federally funded customer, but we heavily subsidize within the university that core, we should not give that customer the discounts for the institutional support. So if we go back to page 2 where we talked about that, or page 3 where we talked about that example with the direct costs and how the subsidies get applied to your fees. So in that case, if we did have the institutional subsidy, you would then have 3 rates. You would have your rates for internal and federally funded customers. You would have your rate for external customers who are federally funded, because you then add back in the institutional subsidy, and then you would have your external rate, which you take out all the subsidies because you don't want to pass on the discounts to them. Questions on that? Okay.
How do you work in people that are paying from drug companies, from industry funding?
So how do you work in the payment for drug companies? We specifically in the Cancer Center do not. They fall under our external rate, so they just do not have any of our subsidies. The government says that you can charge them a lot more than that. So we charge them what is their cost. But we could charge more. You can charge as long as, like we talked about before, as long as you're not undercutting the market, you can charge whatever you want for external customers.
So does that count in that so that's technically like profit, right?
Mm-hmm.
So does that count into your surplus at the end of the year?
It does count. It does count into your surplus at the end of the year.
So
So you can. So one of our cores who does do a lot of external we actually account for that and help to subsidize our internal rates with that amount. That's just how they wanted to build it into their fees. Now, what you can also do with that money is put that money aside. So of anything above your cost, you can put that money aside. There's in 2 instances where you can put money aside. The first is if you build in depreciation expense into your fees. When you recover that depreciation expense, and these are things that kind of get covered throughout these, so we might repeat ourselves. Bless you. When you build depreciation to your fees, as you recover that depreciation, you can move that depreciation amount that the university has given you into another pot of money, which would be a reserve fund. And you have to have that set up especially with the university, because that money then can only go to support the operations of that earnings operation. So you put that money aside to then help you buy new equipment, because we'll talk about in a few minutes how to buy new equipment, because new equipment cannot be built into your fees. So you can put that depreciation aside. You can also put in any money above your cost that you charge the university or you charge the external customers, and you can move that money aside. That is kind of what the guidelines are and say you can do. We've never tried to move anything but depreciation, so I'm actually unsure of how the university would handle that, but that is allowable. If the cost to charge a service is $100, but you're going to charge $200, you're supposed to be able to move that other extra $100 into another pot of money, because that is above your actual cost, and then you can use that money for equipment. You can't use that money to support other operations. You can't use that money for anything outside of cores. You can't use it for anything you want. It has to still be used for the core. But then that's one way to earn money for equipment and things that are needed. You can use it to buy equipment, or you can use it to help subsidize your core in another later on. But you can't use it to give to a PI, or you can't use it to give to other areas or other other funds or other earnings operations, because that money was earned for that operation. You can use it to hire a new technician, yeah. It would go back into you just filter back into your budget. You would still be subject to whatever your institutional policy is on raises. So at OSU, we only give merit increases on the once a year basis, and any other increases outside of that are there's a lot of hoops and rules that come into play. But if there's reason to give a raise for equity, or for if the university or the institution has approved, yeah, this is reasonable that you give this person a raise, yes, that money would be able to then come back in as support to the core. But like I said, it's only to support the core. We cannot use it for anything else. A lot of people do that, though, they actually do it for equipment, though. It's the most common use of those funds. And I just realized I haven't been scrolling wrong for our recorded session here. Where are we here? Okay. Any questions so far? Okay. So we'll go on to question number 2. How should core facilities set charges for users, particularly for use on federally funded projects? The answer is pretty plain and simple. They should set user fees based on actual costs and actual usage. When we're going to get into, and this leads us into the next one, of what are the considerations for determining appropriate charges. They have the cost principles that are in A21. They're the same for the uniform guidance, they're just in another location. The cost of the core facility service must be charged directly to the applicable awards in the form of user fees, charges, or rates. So rates must be based on actual usage of service, or use your best guesstimate. And what this means is, what Dave had mentioned in his slide deck, when you're trying to create your fees for the very first time, when you're trying to set up your earnings operation, you're kind of just guessing at what your anticipated usage might be. So the first year you might get it wrong. The first year you might charge less than, you might inflate your usage, and you thought you were going to get 1,000 samples in, but you only got 200. So that's then how, when you recalculate your fees for the next year, you can then base it off of actual data. So then you either have to increase your fees or figure something out for your fees, depending on how that change in usage affects your fees. So, but the first year you create fees, it's going to be your best guesstimate if you've never done this before. Or when we create our fees, we take what was our actual usage for the previous year, and then we ask each of our shared resource directors, do you anticipate having more services provided next year? Or because we've lost so many PIs and we've lost 4 PIs in Med-Onc, is that going to significantly hurt your usage? If that's the case, then we need to adjust your fees based on the change in usage that you're anticipating. If it turns out we got that completely wrong, we can at one point in time adjust our fees later in the year. The university asks us to submit our fees once a year, but we have had word from them that we can alter our fees once throughout the course of the year. So if we've really missed the mark on our fees and we're coming in and we're not even coming close to meeting our cost, or we're coming in and we're making too much money, we can adjust our fees throughout the year. But when you're creating your fees, it should be your best guess. But your best guess should be based on, the first time you create fees, it is truly a best guess. But then when you create fees in subsequent years, it should be based on actual usage and predicting what's going to happen. Questions?
What if you're starting a new core facility and then you don't know how many users are going to be?
Right. So sorry, I have to repeat the question for our recording. If you're starting a new core, is there some sort of, and you're not sure how many years you're going to have, is there some sort of incubation period for figuring that out? Yes and no. So I'm going to say no, because at to even get your earnings operation off the ground, you need an earnings fund, and you need to have that submitted through the university. And that's one of the requirements, is that you submit what your fees are. So you're going to have to think about these things. So technically, no. But then on the other hand, yes, because if you've completely missed the mark when you created your earnings operation and you're not making enough money, or you're making too much money, then you can reevaluate and come up with what do we need to do to change so that we're breaking even, and then we can resubmit those. So where I want to say, I say no because you have to report on those before you can even get started, but yes, because the university is not going to want you to come in a significant deficit or a surplus, so they'll let you alter those things with good reason. You just say, we anticipated our usage, so we need to adjust our fees based on that. So that'll affect our bottom line. So we covered earlier, the schedule of rates should be used, established documented method. Rates may not discriminate against federally supported activities of the institution, including usage by the institution for internal purposes. So you have to charge internal rates or federally funded rates to internal investigators, but that is also a university guideline. So we're covered in both places with that one. Rates must be designed to cover only the aggregated cost of service. The cost charged for providing each service from a core facility generally consists of its direct cost only. And we'll go through more examples on that. But I think we can get the point that we're driving home that everything has to be cost-based if you're charging federally funded grants. Rates shall be reviewed and, if required, adjusted at least every other year, and shall take into consideration any operating deficit or surplus of the previous periods. So again, that's federal guidelines. OSU requires this every year, and it's usually in March. Records must be retained and made available to federal officials. So as mentioned before, if the government comes in here, they'll want to see all of your documentation on how you came up with your fees. Part C, what are the typical allowable costs for determining rates? So the biggest one is going to be labor and salaries. Cores are a lot of people-based, people and equipment-based. So you can also include operating supplies and materials, service contracts for your equipment, and depreciation for your equipment. And any questions on that?
This includes the manager or director.
It does. It does include the manager or director. Sometimes in ours, the manager or director is only 10% allocated to the core because they just have oversight, and there's usually a technical manager that's 100%. But you can build in the 10% of the director into your fees because their time and effort goes to supporting the core. Do you have a question? No? Okay. What are some types of costs that are unallowable? And we've covered a lot of these. Advertising, but a couple that we haven't covered is advertising. You cannot take out a full-page ad in the dispatch and charge that back to your users. That's unallowable. If the university wants to pay for you to take out a full-page ad in the dispatch, let them. That'll just bring in more customers for you, but that's not something you can charge to a grant or build into your fees that will charge grants. Alcoholic beverages, we covered. Bad debts. So this is actually a big one. So at the end of the year, if you have external customer or you have customers who haven't paid their invoices, and that's leading to a deficit for you, when you roll, and we talked about for surpluses and deficits, you need to build that into your fees. So you either increase or decrease your fees based on that. You have to take in consideration your bad debts. So let's say you are $50,000 in deficit at the end of the year for your earnings operation, but you have $25,000 in invoices that haven't been paid. When you roll your deficit into your fees for the next year, you can only roll in $25,000 because had you gotten paid for those $25,000 in invoices, you wouldn't be in $50,000 in debt. You would only be $25,000 in debt. You cannot roll the bad debts of other customers into charges for new customers. Does that make sense?
How do you handle that with E-Ramp to keep from having bad debts?
So we have an online management system where our customers will place orders. Nationwide Children's and certain of their cores use a system called iLabs, where all of our customers, when they place orders, they have to provide their chart fields. And we have very few instances, unless it's external customers, where any internal customers do, have bad debts, because before they can submit their order and get it processed, they have to provide their chart field information, which is then e-request approved. So that has significantly, over the last couple years, cut down on any internal bad debts. We then, on the other hand, have external customers who we have to send an invoice to, and they give us a PO. We don't do any work unless we have a PO, but we do still have that gap in time where we're waiting on check payment or ACH payment or something like that. So at the end of the year, if we have in a certain core a lot of payments we're waiting for, we can't roll those into, if that shared resource happens to be in a deficit, we can't include those in. We have to account for those in our calculation. But having some sort of ordering system or billing system really helps with cutting back on bad debts and unpaid invoices. Contributions and donations, they cannot be included in your fees. So if a really nice person who's been touched by cancer wants to donate $50,000 to the genomic shared resource because they just know that that's big for cancer research, we can't then include that amount in our fees. So we're not going to take those out, or not. Sorry, I'm talking about this completely opposite way. We can't actually donate or make other contributions. The other examples deals with something else for course. But if we wanted in one of our shared resources, our behavioral measurement shared resources is out in Appalachia taking surveys and things, and they donate to one of the women's centers they go to, that's not then something they can charge through the core to put back in the fees. Does that make sense? On the other hand, what I was starting to lead to for contributions and donations, if someone donates money to the core, we would take that as a subsidy. And so you would subsidize your operations with that. So entertainment expenses goes hand in hand with alcohol. If you buy tickets, you can't charge it back to the core to then put back into your fees. We've ran across this, so a lot of people when they have seminars or banquets here at the university, sometimes they hire a band. And at the CCC, I would not let any of those charges even hit the shared resource because that's not benefiting any of our customers and that's not allowable for the core. But say it did hit the shared resource, we would request institutional support for that to come in and show an offset of that expense so that it does not get rolled back into the fees for our customers. Fundraising. If fundraising and public relations, it's going to be very rare, just like entertainment expenses. These are types of things it doesn't make sense to even have on a core. So why would you even do it? Why would you pay for anything for fundraising out of your core operations or anything? We can't donate to a public figure. If you just think of the prudent test, why would we even do that out of a core operating? But the government thankfully has told us you can't do it. So even if you weren't sure, they say just don't do it.
Even if your director's pushing for it.
Yeah, just don't do it because it doesn't make sense. If it's not one of those 5 things that we covered before, salaries, operating, service contracts, depreciation. So I say 5 because we always classify things as supplies and reagents because to us they kind of mean different things. So those 5 things, if it's not one of those 5 things, you shouldn't be charging it to the core.
What about repairs and maintenance?
So that falls under your service contracts. Yeah. So we actually get this question a lot and I'm a part of an organization that handles core administration across the country. And a lot of times people ask, because core service contracts on equipment are very expensive. on a large piece of equipment, they can be anywhere between $50,000 to $100,000 a year, and you have to roll that fee back into your fees. So that increases your fees for customers. But is that reasonable? So some institutions, and it's not one that our university has started doing, they've started instead of putting money into a service contract and paying it, they build a little bit of service and repair and maintenance into their fees, but then they take that money and they put it into a separate pool. So I guess that would be a third area where you can move money into a separate pot. But then that money can, because you built it into your fees for supplies or services and repairs, you can only use that money for services and repairs. So you're building up a little bit of, that really depends on the piece of equipment and the operations of the core. Because if you're going to not get a service contract on $1 million piece of equipment, and that piece of equipment breaks 6 months after you decide not to get a service contract, you're then out of all the money to have someone come in and repair that. So that is kind of tricky. I wouldn't recommend doing that for an individual core. I would only recommend doing that if you have a group of cores who kind of are working together. You're going to have a lot of money.
I wanted to ask about, let's say you have a PO for $25,000 for RNA-seq foundation samples, and then RNA-seq experiment is going to work. So that's not included in that yet, right?
So if you were using one of our shared resource and your experiment failed, we would have to charge you for the experiment because we did the experiment, but it would be based on what happened, what caused the experiment to go bad. Was it that the samples that came in, they were bad, they weren't great quality, so they was going to fail, and then if that was the case, did we communicate that before? Did we know that before? And then the PI just decided to continue on even though they knew that their samples weren't of great quality? Or is it the case that sometimes the chips that we order from vendors, sometimes they're bad? So if the chips were bad, there are instances where we could just rerun the experiment for free. If it was on behalf of the PI, they knew that we gave them full warning that their samples were bad and they were poor quality, we weren't going to get enough tissue or RNA out of them. We let you know that, and if that's the case, then we would charge for the rerun of the samples. But if it's the case where we didn't know, it looked like it was going to be fine, all of the data was there, or all of the tissues and stuff were there, and looked like great quality, and something went awry with either the equipment or the chips or something like that, then we would work out a way to just rerun the samples at no cost to the PI. So it's really dependent on the situation. Dave, do you have any situations like that? All right. The next question about aggregate costs is kind of just a review of things that we've talked about. So part F, is it acceptable to estimate costs and determining initial rates that would be charged for new services? So we kind of talked about this, and the general answer is yes. The method for estimating costs should be applied consistently within the core and without discriminating against any user. So if when you've determined your fees and you think, well, I'm going to charge 60 hours for tech time and then we're going to charge back reagents, you need to be consistent for every PI. That's what every PI should get when they're doing a project with you. You shouldn't say, well, this PI is going to get charged hourly and then get charged back the exact cost of the supplies and reagents, but we're going to create a sample fee for this PI. That's not going to work. Everything should be consistent, especially when you're just developing your fees. So then the second point, the method and details involved in any cost estimate must be documented and available to review by the institution or the funding agency. So again, everything must be documented. How should core facilities recover F&A costs from users? So this is actually a thing that is different across all institutions. For core facilities at OSU, we do not charge extra for the F&A costs. I don't know, do you, Dave, and yours?
We're actually exempt from that.
Okay, Yeah. So if you guys don't know how kind of grants and things work, when a customer pays with a federal grant and that we charge their grant for our services, OSP or the grant or the funding agency gets charged the F&A rate on top of our services. So we charge $5,000 for our order. The F&A rate on the grant is 52.4%, so that's going to equal, the grant is actually going to get charged $72,000 or $7,250 something $1,000 or $7,200,000. So, but we as the university, as the Corps, do not get that money back from the F&A rate. That stays with the university. There are other institutions across the country that do that a lot differently, but that is how OSU handles F&A. The F&A stays with the university. There are other, just as examples, there are other institutions that when they charge a grant, they actually charge the F&A rate, and then they have to then give the money back to the university. Or there are other institutions where they charge the F&A rate, and then they get to keep a portion of the F&A rate for things as for service contracts and capital equipment and those types of things. So OSU keeps all of the F&A rate and overhead rate. That is another thing you can build into your fees, is if the university charges a overhead rate on any service you provide. It's 5.7%. So when we calculate our fees, we include a 5.7% overhead rate when we calculate our fees. That goes back to the university to pay for lights and plows and physical maintenance and those types of things. So we'll go ahead and skip the general core operating principles. We've covered them, I think, in depth over the last 2 hours, except for A. Can a core facility purposefully accumulate profit from its charges to internal users? No, they cannot. But surplus for charges to internal institution users may be applied to reduce rates charged, so rolling that surplus back in for the next year's fees. It's not appropriate to bank funds for expenses that may be incurred in future years. Core facilities are expected to operate in a manner that allows them to recover only the cost of providing services. So no banking money, those types of things. Can a core use an operating surplus to purchase equipment? And this usually spurs a lot of questions and debate, so we'll just go ahead and dive right in. The answer to that question is no. You cannot take any surplus and pay for equipment. You can put depreciation costs into another bucket. You can use any surplus that is provided to external customers. You can put that money into another bucket, but you cannot use funds that are accrued or surpluses for capital equipment. The difference, and you cannot build cost of equipment into your fees. So if you need a new piece of equipment that costs $100,000, you can't add that to your operating expense for the year, put it in, and charge customers more money that year for a new piece of equipment.
Is there a reason why? Like, is there something that specifically states why you can't buy equipment with user fees? Because you're buying equipment for...
There's no reason why. If the why would be here, it would be here. The rule is just no, that you can't.
You can't make a profit, and
Yeah.
therefore you don't have extra funds.
Non-capital equipment, which is under $5,000, that can be included in your fee. So if you have a new centrifuge or a new something, non-capital equipment can be added or can be purchased with core fees. But if you're buying, then there's always a gray area in what you include to be capital equipment. Is a freezer, a new freezer, is that capital equipment? Is software capital equipment? We're waiting out. Actually, I have questions in with ABRF to determine if software that costs $15,000, is that considered capital equipment? So, which are things we can get back to you on. I have put a good effort in to say, no, it's not capital equipment. The job cannot be done without this software. It's part of our operating charges. So we'll see how that pans out with the question with the people who helped write this document. Now there is a provision in here for lease or rental equipment. So if you have an operating lease, meaning you get a lease for a piece of equipment that when you're done using, it's going to go away. And we're only going to lease it for a year, and then it's going to go away. Those fees, those operating lease fees, can be built into your fees. But if it's a capital lease, so capital lease indicates that you are going to possibly purchase this piece of equipment at the end of its life, or at the end of the lease, those fees cannot be built, or those costs cannot be built into your fees. Because then essentially you would be purchasing the equipment. So, and think of an operating lease as a renting agreement. You're only renting the equipment with full intent that it'll go back to the vendor. Questions on that? I think just in thinking about your question about why equipment can't be, so not only because of you have to break even, but a lot of equipment is funded by the government. So they're already giving support for equipment, and they have equipment mechanisms to buy equipment that then they don't want to them. Sometimes they try to not double dip. So that might be part of the reason why they have the S10 and the S10 grant and the high instrumentation grants.
Well, that's fine for large pieces of equipment, but I mean, for example, in my labs, I mean, they have to use biosafety cameras.
Yeah.
So they can't do their job without it.
Yep.
So if we can't buy any biosafety cabinet, if they don't have enough money, then
So the difference, so I would look into whether or not the university, when you purchase that, classifies that as capital equipment. If they don't categorize that as capital equipment, then that biosafety cabinets would be fine. I don't know if we've had to buy one recently, if we've had institutional support for that, or if we've paid for it.
how does it get defined as capital? I thought it was just above a certain cost.
Usually the university will decide when they tag it if it's capital equipment or not. So that's something you should talk to your fiscal person. How much usually does a biosafety cabinet run?
I think it depends. I mean, anywhere, from like 9 to
Yeah.
something like that.
I think that'll be, I think a university guideline is if those get tagged. We haven't had to buy one recently so I don't remember off the top of my head.
And some of mine are tagged and some aren't.
Yeah, I think they should. Yeah, I think they should be tagged. So, just so they don't get up and move.
Theoretically, you've got your depreciation if you calculated and are using that. But
So,
timing on that is.
yeah, we go with the $5,000 because that's another part of the uniform guidance says that $5,000 and above is technically in their eyes capital equipment. So we probably would get institutional support for that, the biosafety cabinets. So part C, my core provides a project level service that may take months to complete and may be subject to change in scope or cost as the project moves forward. How can I develop an acceptable system of custom charges? So one thing we guide our shared resources to do is when they're budgeting and working on, when they create a quote for a customer and they see that it's going to take a long time, if it's going to cross fiscal years, we ask them to budget or quote in a 3% increase in fees so that is already being taken into consideration. And when things take months to complete, and this actually bleeds into the next section of how often should my core bill for usage. We ask our cores to bill as soon as things are completed, and we then charge on a monthly basis. But if you're working on a large project that's going to take months to complete, we would request for our cores to bill as they go. So bill incrementally. So if you bill either weekly or biweekly for the things that you've already completed on the order or the project, so that you're recovering costs as you go along and not waiting until the end. Because as you know, as you're running a core, you're incurring costs, you're incurring salaries, you're incurring the supplies that it takes to run or to do the project. So bill is incrementally. We said before you can't pre-bill, but definitely bill in smaller amounts. Any questions on that? Joey, I need you to yell at me when I'm not scrolling the thing. because then I just get lost in where this is. Okay, so the next question, can my core bill now for work that will be performed later? No. The answer is just basically no, but billing in advance of the work of receipt of prepayment is not allowable. However, institutions may choose to divide the work into smaller billable units in order to appropriately recover incremental costs for long-term project work on a timely basis. So I had just mentioned that. You'll want to bill as soon as you finish things so that you're getting paid back for the work that you're doing, but you can't pre-bill for things. If a core director or other staff scientist is awarded a shared instrumentation grant, may the PI of that grant and other co-PIs be charged discounted user fees as a benefit of the award? The answer to that is also no. User fees that have been appropriately developed will not include any costs associated with federal support provided for acquisition of new shared instrument supported by NIH grant or other federal projects. So there is no basis for a discount or credit to be applied. If a PI additionally we've added, if a PI gives equipment to a core, they cannot have a discount. You cannot pay for services with equipment, and the PI must pay the same rate as everyone else. The way around this would be to split ownership. So to go into more details about that. If the PI gets a federal grant, or say they had a piece of equipment they're not really using anymore, so they're going to give it to the core, but when they do need to use it, they want the core to give them a discount. That's not allowable. What can happen is that if the PI gets a shared instrumentation grant or buys a large piece of equipment with their own startup money or their own funds, they can share that instrument with the core and say, the core gets to use it 50% of the time, and I'm going to use it 50% of the time. So I'm going to use it on my own. I'm going to have my own technicians who do it. I'm not going to use the core for anything regarding this piece of equipment. But the core can then use it when they need it 50% of the time. And then the core would pay half of the service contracts and et cetera. So, and half of the repairs if it were to break. And so the core can build the half of the service contracts. They can build that into their fees and then their tech time for the fees. So that's one way of doing it. So just share ownership. That we run into that problem a lot in the cancer center because we have PIs who get large startup packages when they come and they buy equipment and they're like, well, I'm just going to put it in the core, but I want my services for free. We get that so much. And we have to tell them, no, that's not allowable. If it's one of our CCC members, especially not allowable because we want to be able to track their usage. We track usage on anything and everything that our cores do. So if it turns out to be a situation where we're going to split the cost or split the use of the core, anything that PI does on that does not benefit the cancer center in any way. We can't track their usage. We can't track the publications that come out of the work that has been done on that piece of equipment. So it becomes really tricky, and we try to stay away from those situations. We try to counsel PIs in what to do when they want to buy a piece of equipment and what that's going to mean for them later and not just let them do it. Any questions on that?
What kind of documentation do you normally do after this split?
We create an MOU. We write an MOU for any documentation showing a split or a special agreement on a piece of equipment. We had a piece of equipment that a PI did buy with his startup package and his program package, and it's now getting moved into the core. And he knows that he now will have to pay for services. That was an agreement upon purchasing of the equipment. He knew that, and it was agreed that once he had it, it would eventually get moved into the core when the core was ready for it. But at the time it moved, he would have to pay for the services. And then there's also agreements that you can set up that sure the PI will agree that they will pay for the services, but you can also give them priority on the equipment. That's another way to work around this, is to say, thank you for your contribution to the core, and when you have projects, we'll make sure that those get put to the top of the queue whenever you have the projects. Obviously, you're going to want to do this for a PI that's not going to flood the equipment with projects, because then that doesn't make any sense to even start this arrangement. But if it's a PI who's going to occasionally use the equipment or something like that, then that's very reasonable to give them priority, but they cannot receive a discount.
Being proactive is the way to go. PIs don't even understand
Right.
I get that.
Okay. Can fee schedules cap the amount charged to a user in a particular time period? The answer to that is generally no. Fee cap charges at a certain dollar amount per month if more than a certain number of hours or units are used are not consistent with the applicable cost principles unless the institution or some other federal funding supports the difference between the allocable cost and the amount charged to a heavy user. So what that means is for the first 500 hours you use on this piece of equipment, you're going to get charged $1,000, and anything above this is free. So basically you're going to just be charged $1,000 for unlimited usage. And that doesn't meet the guidelines, because if you're using the equipment and you get charged $1,000 for using 500 hours, but Gala uses it for 1,500 hours, you're now not getting an equal hourly rate. And that's what that guideline is pointing at, is it doesn't allow people to get the same rate. Any questions on that?
Is this the same as volume discounts?
Yes.
Say up to 500, you pay one rate, then more than that,
Mm-hmm.
lower rate?
So it's very similar. We actually do some volume discounts in the Cancer Center, but they're very large volumes. So if you have, we do, and it's only, it's really in our genomics course. If you have over 500 samples that you're giving to us right now, 500 samples of next-gen sequencing data, we have a different tier of pricing. But that pricing is eligible to all investigators on campus, and it's subject to change. So say we've quoted you at the 500 sample price, but you only bring us 499. You're now going to get bumped down to the under the 500 sample price. That's just kind of the way that it has to be. We have to you can create a new tier of fees, but it has to be applicable to all users, and you have to stick with it. You can't just be like, oh well, you brought me $4.99, so it's fine. We'll just still give you the discount, but you're still charging on a per unit basis, and you're not going to say you brought me 500 samples. Anything above 500 samples is free. That's not allowable. You just have a different cost because of the amount of samples you have, and anybody can have that. Do you understand the difference? That above a certain threshold becomes free, because then if I use 501 and someone else uses 750, they're getting a way lower sample cost than I'm getting for my sample costs. So you're fine.
So is your tiered pricing then based, is it like a range of samples or
So it is. So if you bring us if you have a project for 5 samples, you just get our base rate, our regular rate. And if you bring us a number of samples, you place an order from any samples from 1 to 499, you get 1 rate per sample. But then if you are going to submit 500 or 505 samples, you then just have, like, let's say the first sample rate is $100 per sample. The second sample rate is $70 per sample. But you're still getting paid on a per sample basis. I'm not saying that we're just going to not charge you for those samples over 500 and then that's your discount, because that discount's not the same for every PI.
We do a similar thing in our A&D lab that plates for one of our pieces of equipment. It's one cost for us to buy the plate if we buy just one, and a discounted price if we buy 5. And so we cost our costs at the whole plate level. And so if they need enough to use most of the 5, it ends up being a discount on a per sample basis.
Mm-hmm.
We charge them for that whole 5-pack,
Yep.
no matter how many they use.
That happens in our core as well. So we have chips that we can only use a chip for one customer. It only holds 12 samples. If you need 1 sample done, you're technically, the charge is on the chip. You're buying 1 chip. But if you have 13 samples you need done, you're buying 2 chips. So the actual rate, it also, you can kind of figure some things out depending on what your actual charge in your unit is. So in that case, we're not charging by the sample, we're charging by the chip. And so the chip rate is the same for everybody. It just, you can fit a different amount of samples on each chip. Okay. accommodating different types of rate payers. Where do funds to pay for core facility rates come from? Usually they come from internal customers or federal grants or other sources like clinical trials, pharmaceuticals, and any other payers. Proper documentation and accounting for the rates paid by all users will mitigate concerns related to parent differential treatment. Any appropriate accounting and methodology that ensures that federally funded users are not charged more than cost or discriminated against is acceptable if consistent with applicable federal cost principles. So basically, any way you want to determine your fees, it just has to show that federally funded people are not getting charged more than what your costs are. How can my core acceptably bill usage to users with multiple federal awards and funding agencies? So you'll want to charge the award that actually has the services budgeted. So if you have one project and it spans multiple projects, you'll want to make sure you work with the grants person to determine the actual costs that are allowable for each grant. It's very rare that we have two grants paying for one order or service because that's kind of hard to do. So we usually try to split that out and say these 5 samples are for this grant and these 5 samples are for this grant and run them separately. But if you're going to bill them, make sure it's clearly defined and documented. Is it allowable for core facilities to be subsidized for particular sets of users or grants? Let me see, make sure we don't have any notes. So in some ways, in some institutions, when they get a subsidy from the federal government, they actually use their subsidies differently. We put it on the salaries. It's the easiest way to do it. We reduce the subsidies on the salary, or we reduce the salaries by the subsidy. Some institutions actually take that subsidy and put it on individual services and say, we get $50,000 in subsidy from the federal government. That's going to, 10,000 of it is going to subsidize this service, 10,000 of it is going to subsidize this service. And that's what this is saying. We don't particularly do that here at the Cancer Center, but there are ways you can do that. You can subsidize individual service lines. Thanks, Joey. Are there any circumstances when one federally supported project may be charged a reduced or discounted rate compared to another? And the answer of that is going to be no. Rates used to charge the cost of the service must be charged to internal institutional users on a consistent basis regardless of funding source. So internal customers and federally funded customers must get paid the same. Billing rates should not discriminate between federal and non-federal users, including internal institutional activities. The schedule of rates will apply to all users of the core facility on the basis of actual utilization and cannot discriminate against any one segment of the population. A core may have multiple rates for the same service when those rates are properly established, consistent with the applicable federal cost principles, and the favorable rates are available to all users that meet established criteria. So the answer to that question basically is that you can't charge a different rate to another one federally funded over another. But you can have different rates based on who the payer is. So if it's an external federally funded person, you can take out those institutional subsidies. If an investigator acquires an instrument on a project and this instrument is assigned to a core facility, can the investigator's usage be given preferential treatment? And we talked about that. Yes. If an investigator acquires the equipment and they're putting it in the core, they can require preferential treatment. They just cannot receive a discount. Questions? Some of these, because I get ahead of myself and I explain things, we might start just duplicating information. Non-institutional usage. Can a third party, for example, another biomedical research institution, educational institution, or commercial for-profit organization be charged at a different rate from the institutional rate? And the answer to that is yes, and NIH encourages you to do so. How should an additional fee in excess of the cost of service generated by a third party be treated. And we talked about that, and there's some information here about program income. But here, excess of full costs may need to be treated as program income. You'll want to talk to a sponsored program officer if you do have any income that is created or generated in relation to a federal award. So I'm not an expert on that. We don't have any in the Cancer Center that have any money, any surplus that's generated based on a federal award. All of our award money for the CCSG, which is the Cancer Center Support Grant, goes in as a subsidy, and it's not our income isn't in relation, it isn't due from getting that award and that money. So there's a difference in that, how that plays out. So I would recommend talking to a sponsored program officer about whether or not you're subject to the program income guidelines. What is depreciation? So basic and general accounting depreciation is when you buy a large capital asset, it depreciates upon use and time. And there's a dollar amount attributed with that. There's different ways to calculate depreciation, but the university uses one method, and their dollar amount that they calculate is the only dollar amount that you can use. If you want to use a straight line method and they use a different method, or if you want to use rapid decreasing method, right? So if you think that there should be a different method, unfortunately the university is kind of sticklers about you have to use their depreciation amounts, and you can just request from the controller's office what depreciation you have accrued on your equipment. If your equipment was purchased with federal funds through an S10 grant or a high instrumentation grant, or it was a piece of equipment that you purchased due to just part of your grant budget, those things cannot accrue depreciation because they were bought by the government. So depreciation was only accrued on instrumentation that is purchased with university funds. So how is depreciation used by core facilities and setting rates? Appropriately applied depreciation would be considered an allowable cost of providing service with some limitations discussed below. So those limitations, question being, can depreciation charges be applied to the cost of instruments and equipment purchased with federal funds? For example, S10 Shared Instrumentation Grant Program. And the answer to that is no. If the equipment was fully supported by federal funds, they can't recover the depreciation expenses in its user fees. And that's kind of what I just mentioned, because inclusion will result in duplicative charges when used on a federal project. So, for example, if you purchase the equipment with federal money, and then you were to charge another grant for the depreciation expense, you're then charging the government twice for that piece of equipment because they purchased it for you, and now you're charging for them for the depreciation. So that is why you cannot recover depreciation expense on equipment that was purchased with federal funds. But it does say if some of the funds for the equipment were purchased with non-federal sources, depreciation charges for that portion can be included. So if you had a cost share on a piece of equipment that was sponsored through the government, then the cost shared piece can accrue depreciation. And then must depreciation charges be applied to the cost of the instruments and equipment purchased with non-federal funds? It does. So the answer to this basically is it doesn't have to be. So it says must depreciation charges be applied, and that's going to be completely up to the core facility. So if you if the depreciation cost isn't going to increase your fees dramatically, or if the depreciation fee is negligible and you're not even going to get enough to do anything with, it's completely up to you. But in the case that you do or do not apply depreciation fees to your depreciation costs to your fees, will dictate whether or not you can move that money into another pot for later capital expenses. So, for example, if when you create your fees, you do not include depreciation expenses into your fees, but then later you have a surplus, and you're like, what am I going to do with the surplus? I don't want to decrease my fees by that amount. You can't then go say, oh, that was depreciation, I'm just going to move it, because now you don't have a documented method saying that you added depreciation into your fees. So that is, so that it's up to the Corps on whether or not they're going to apply depreciation expense. But that's kind of one of the things you want to think about is, am I going to later come back and want it there, and I'm not going to be able to call upon it if I didn't build it into my fees. Okay, questions on FAQs or the uniform guidance, A21 in general? We're almost done. Dave only has like 4 or 5 more slides to go through. It's only 4 slides, so and then we'll finish up for the day. So before, when we only had the 3 sessions, and while I'm talking, I will get that up for Dave, we would always end early, but now that we're down to 2, we're probably going to go the full time for both days. But we will get you out of here as quickly as possible.